All right. Hey, everybody. Smart Silver Stacker here. Welcome to another live stream. So, today we are seeing a bit of a sell off across markets. The silver price today down at the time we are doing this live stream over 2%. Silver futures down over 3%. This sell off, though, is not relegated to silver by any means. You have got gold down almost 1%. The gold price trading at the lowest price in the past 2 weeks. You've got all the major stock indexes declining today. You've got palladium getting hit nearly 4% sell-off in the price of palladium. Platinum's down. So look, everything across the board pretty much selling off today, silver included. The catalyst for this is the release of the ISM manufacturing PMI, reflecting economic activity in the manufacturing sector contracting in August for the 5th consecutive month and the 21st time in the last 22 months. At least this seems to be the primary economic data that was released, triggering this sell-off across assets. So we'll dig into this report in just a moment, but first of all, I just want to take a look at the chart of silver and see, is this something we should really be worried about, or should we just be looking at this perhaps as an entry point, a nice discount on silver, a place to perhaps accumulate more, and, not surprisingly, perhaps to many of you, that is kind of what I'm leaning towards, but this is not without, some data driving that decision process. So silver, if you look at this longer term chart going back to earlier this year, you can see that it's really in a bit of a consolidation, a triangle. We had a big breakout, and it's just been bouncing around between the top and bottom trend line here. Now, we haven't quite touched this bottom trend line, so maybe silver has a little bit further to fall, but let's take a look at the gold to silver ratio chart. And I think that may give us some clues as to, the shorter term action here. So you see gold to silver, let's see, let's make this full size. So this is the gold to silver ratio. And we've been watching this. Obviously, we keep a close eye on this because this is one of the most important indicators when it comes to the precious metals market. And we had a breakdown from the gold to silver ratio, which touched this resistance line, which dates back to 2022. We had a breakdown from it earlier this month as the metals rallied, but now we've got this kind of sell-off, and it's coming back up to this line. Now, I don't expect that the gold to silver ratio is going to break this line. If it does, that would probably portend a massive sell-off because this ratio tends to rise as the metals are falling, and then when the metals catch a bid, it tends to drop. And to me, it looks like we are set up for a decline in this ratio, which would mean that we are probably looking at a bottom in the price of gold and silver, if not here, then very soon, maybe after a slightly larger decline. As far as physical metal goes, when we see the price of gold and the price of silver dropping, that's the days when I like to accumulate. And SD Bullion just launched some really fantastic sales this week. Notably, they've got U.S. Walking Liberty half dollars on sale for $1.99 over spot. You can get a roll of these, any quantity, for $214 right now. And if you think about this, back in May of 2023, a little over a year ago, the spot price of silver was much lower than it is today. And yet these coins were selling for a higher price than they are at the moment. So I think these represent one of the best deals on physical metal at the moment. I love junk silver, and I suspect that given the economic backdrop that we're looking at here, which, people are concerned about the economy. That's why gold and silver are selling off today. But, the potential for these coins to rise in value significantly really does exist. Not financial advice, but this is something I would be looking at accumulating. So let's take a look at the data that was released this morning, which paints kind of a very negative picture for the U.S. economy, not surprisingly. So we've got, as I mentioned earlier, the 5th consecutive month of contractions, and we've had almost 22 months of contraction, one exception there. And what the ISM is telling us here is that demand remains subdued as companies show an unwillingness to invest in capital and inventory due to current federal monetary policy and election uncertainty. They also go on to say here, these are respondents to the survey that they're quoting from the chemical products industry. They're seeing a noticeable slowdown in business activity. Staffing and production rationalization has been triggered. Previous optimism about future growth has been dashed. You've also got the transportation equipment industry saying that the backlog has dropped in half as invoicing remains strong, but orders have slowed significantly. They are hoping to see orders pick back up in the fourth quarter and into 2025, but expect third quarter to remain slow for incoming orders. And this is kind of the same story. There's a lot of concern about the election and the effects that that will have on the economy. And also, they're waiting for the Federal Reserve to begin cutting. Before businesses really double down on investing in plant and equipment. From the machinery industry, the same story. New order intake is sluggish at best. Interestingly, even though orders are down, inquiries are up. Customers have indicated capital has been approved for equipment purchases, but they were directed to put projects on hold until the fourth quarter of 2024. This indicates the uncertainty around the election. We anticipate a strong end of the year with a rise in backlog going into 2025. So not a great picture being painted here for the U.S. economy, specifically the manufacturing sector, the part of the economy that actually makes real things. And on the back of this news, it's very interesting the dynamic that we're witnessing here, because you've got markets selling off, but on the release of this news, the anticipation of deeper Fed rate cuts actually has gone up. So if you look at the CME FedWatch tool here, the anticipation of a 50 basis point rate cut has risen to 41%. Yesterday, that was down around 30%. So markets are anticipating more easy money because likely of the weak economic data. And, they know that the Fed is going to have to get ahead of this thing and begin easing to stimulate the economy. And yet still you're seeing things sell off. So kind of a mixed bag. But once the Fed starts printing, I think that all of these assets, whether it be gold, silver, the broad stock market as a whole, they're likely to begin to rise. And the reason for that is because when the Fed begins to cut, what you're going to see is the cost of borrowing declining, right? So people are going to be able to buy things on credit, which it will be highly inflationary, but it does mean that, the demand for goods and services is going to be on the rise. Silver is an industrial metal, and if you'll notice today, the biggest hits are occurring in the industrial metal sector. Silver, copper, platinum, and palladium. Those are all primarily industrial metals, and they are getting hit. But once the Fed begins to cut, businesses will likely be investing in new equipment. Consumers are going to get a lifeline. Now, ultimately, the prices for everything are going to move much higher. There's going to be a lot of inflation. It's not going to be a picnic. And, the Fed probably, if they were really concerned about the overall well-being of the economy, they would probably keep rates elevated for a sustained period. But that's not going to happen, right? What they're really worried about is getting the next quick hit for the economy, getting, the fix of what it needs, what it's addicted to. And that's more easy money, more fiat currency pumped into the system. Goldman Sachs, they put out a letter yesterday, which I thought was interesting. They've turned very bullish on gold over at Goldman Sachs. Their forecast is now that gold will rise to $2,700 per ounce by early 2025, and this will likely be the result of rate cuts at the Federal Reserve. And again, today's weak economic data, I think, just confirms that we are going to get a lot of fiat currency printed in the near future. So I want to look at the reasoning behind Goldman's forecast here, because it is interesting. So they said in a note that gold should hit $2,700 by early 2025. That represents a potential upside of about 7% from current levels. In this softer cyclical environment, gold stands out as the commodity where we have the highest confidence in near-term upside. That is what their analysts are saying. And they gave 3 reasons why they believe gold is going to be going on to record all-time highs by 2025. They say that first, they believe that the tripling in central bank purchases since mid-2022 on fears about U.S. financial sanctions and U.S. sovereign debt is structural and will continue, reported or unreported. That's interesting that they throw that word in there. We know that China, the People's Bank of China, the biggest purchaser of gold last year, one of the major purchasers in Q1 of this year, but Q2, allegedly, they've stopped buying. And that actually put some downward pressure on gold when they announced that. But perhaps they are buying and just not reporting it. Put a 1 in the chat if you think that it's possible China could be buying up gold, but simply not reporting it. Now, the second reason they give here is the imminent Fed rate cuts are poised to bring Western capital back into the gold market, a component largely absent of the sharp gold rally observed in the last 2 years. Now, that's very telling as well, because there's been a lot of money that has been sequestered away in money market accounts, high-yield savings accounts, U.S. treasuries, these perceived safe paper stores of wealth that have been yielding a higher amount because of the Fed's rate hikes over the past 2 years. But now when the Fed begins to cut, and I suspect that the Fed is going to be cutting a lot more than markets are currently pricing in and anticipating because, well, we'll talk about the economic data related to jobs here in just a moment, but suffice to say that the data that we are seeing, even though it might look bad, it probably isn't painting the whole picture. So I think rates are going to get cut faster and deeper than what is currently being priced in. And what that means is that money won't be able to get the yield that it currently has in some of these other instruments like money market accounts, for example. And that means it's going to flow into other assets, right? It's going to look for yield in stocks. It's going to look for inflationary safe havens in gold and also silver. And industrial metals also are going to be getting a bid as all that money flows out into the economy and stimulates activity. Then the third reason they say here is that gold offers significant hedging value to portfolios against geopolitical shocks, including tariffs, Fed subordination risk, and debt fears. Now, this is one of the things that we need to look out for as we head towards the election in November. They mention tariffs here. And now, if Trump is elected, there likely will be a significant number of tariffs imposed. That could lead to trade wars, economic uncertainty, the risk of sanctions. And, that means that gold is going to be one of those assets in high demand globally to shelter themselves during times of economic conflict. Central banks, foreign governments, even investors in the West are going to be looking at gold as a safe haven, and also geopolitical risk. The Middle East, is on the edge of a major regional conflict. You've got Ukraine now occupying a significant portion of territory inside of Russia using U.S. supplied weapons and funding. I've even heard tell that there may be Western mercenaries operating inside of Russia's borders. I'm not a military guy. I'm not a real geopolitical analyst here, but I don't think it takes a genius to see that there's a lot of risks in the current environment. And so all of this will likely lead to higher demand for gold moving forward. And so, I think $2,700 by 2025 is a very conservative estimate. And where gold goes, silver ultimately is going to be following. So I suspect we will see higher silver prices as well. Now, I want to talk briefly about the jobs data, too, that's going to be coming out later this week. So at 8:30 a.m. on Friday, the U.S. employment report will be released for August. And if you recall, the previous month's jobs report caused quite a bit of concern regarding the U.S. economy. The jobs print for July came in at 114,000. That was well below what was expected. And also, we got the revision to the year period from March 2023 to March 2024. which showed that more than 800,000 jobs that had originally been reported turned out they weren't real in the first place. So, we may see this Friday more surprises, more shocks when it comes to the jobs data. I mean, not shocking to many of you, I am sure, but shocking to the markets and the algorithms that take this data as, accurate data. But look, one of the things that's going to drive gold and silver much higher is when it becomes clear how weak the U.S. job market really is. We got a taste of that with the last jobs report when it was revealed that they had reported almost 1 million jobs that turned out, never really got created. They were just a glitch in the system, I guess, an artifact, or, perhaps you take the view that it was intentionally doctored numbers to paint a rosier picture for the economy. I mean, I think that is probably likely the case. But we haven't seen the end of this, reality check on the jobs data. And when that comes due, and it might come due this Friday, who knows? I think it's going to be very obvious that the Fed not only is going to have to be cutting rates, but they're likely going to have to perform other forms of stimulus as well. I don't think cutting rates is going to get the job done for what they need to do. They're going to need to print up a lot of money. They're going to need to buy up a lot of U.S. treasuries in a return to quantitative easing. And when that happens, well, $2,700 gold is likely going to be something you're going to see in the rearview mirror. And, silver, who knows? I mean, silver could be taking out new record all-time highs once that realization occurs. But for now, silver remains very cheap. You've got it actually recovering now, it looks like, from the lows of the day. So, hey, anybody who was able to snap up some silver when it was down at just over, well under $28 here, around $27.70, the lows of the day, nicely done. Looks like it's rallying a bit here, but I don't think that we're really going to see any significant moves here in gold and silver, barring, a black swan event this week. It's a low probability event until we get that jobs data. But keep an eye on that jobs data later this week, because that could be something that really moves the needle on gold and silver. I think today is just a buying opportunity. And, a lot of people will say, well, silver has a lot of buying opportunities. Well, it's true. I mean, there are a lot of buying opportunities in silver because it is a highly volatile asset, right? Which is kind of nice if you're stacking it, if you have the guts to buy when it falls, because it tends to fall rapidly and then react to the upside. And you can see, there's many buying opportunities on this chart. If you go back over the past several years, silver, of course, now still at the highest level since, let's see, June. You got to go back to June of 2021 to find a time when silver was trading at current valuations. But look, let me know in the comments down below what you think about this move in silver. Is it going to fall further? Are we going to see a recovery? What will be the factors driving it? I'd love to know what you think. How bad is the economic data going to be on Friday? What is the jobs report going to look like? Leave me a comment down below to let me know what you think. Thanks for watching, everybody. Stay safe and happy stacking, and I will catch you next time